Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you are tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. The best way to do that is to follow me on X at Focused Compound. Go to focuscompound.com to get access to investment write-ups from Geoff going all the way back to 2005. And of course, if you're interested in learning about our money management services, you can reach out to me at andrew@focusedcompounding.com. So in today's podcast, we're going to be going over a question that somebody had sent in. And I want to stress this as much as I can to everybody listening. If you have an investing question or topic or anything that you want us to cover on the podcast, email it to me at andrew@focusedcompounding.com. That helps keep the content fresh and come up with a bunch of new ideas. So email me, andrew@focusedcompounding.com, if you have a specific question related to investing, and we will be happy to queue it and pull it for the podcast. So actually, before we jump into that, if you're watching on the screen right now, wanted just to go over some of these charts, Geoff. And this is a dated chart, right? So I have to just give that disclaimer that I think this chart was from, 2 weeks ago now. But it's talking about, NVIDIA's crazy rise and the weight of that in the S&P 500. As you can see right here, S&P 500 percentage weight industry groups, semiconductors are starting to, go crazy. I mean, I think what's NVIDIA right now? Like a $4 trillion market cap. It's kind of like trillion here, trillion there. A couple weeks ago may have been 3. Now I think we're at, a couple. Let's actually pull it up right here. Just because for people listening, we're recording this on June 20th and things are moving a trillion, it seems like pretty quickly. 3.22 trillion, according to Google Finance. Pretty crazy, but some of these charts are just incredible, right? Magnificent One. NVIDIA is now worth more than Meta, Tesla, Netflix, AMD, Intel, and IBM combined, Geoff, combined. Things you definitely don't see at the bottom. Let's see, Eating Canada. So the stock, NVIDIA is now worth 2.88 trillion, which is now we're actually worth more and larger than the entire Canadian stock market, right? Let's see, it's coming for the king. Who's the king? Looks like that's Apple. 10 years ago, Apple was a $400 billion market cap. NVIDIA was $8 billion. Today, basically the same enterprise value. I didn't put this in this, presentation, but I saw online today, I didn't fact check it, so I don't know if it's true, but basically they're saying if you join NVIDIA in like 2017 or 2018 at a base level engineering position, the individual said you were paid a salary of like $70,000 to $80,000. But if you fully vested the options or the stock that you would receive from the company, that would be worth $10 million today. Pretty crazy. And this chart right here, assume you're given 2.7 trillion to buy 100% of these companies and forget about debt for a minute. Which one would you choose? So NVIDIA, 2.7 trillion, which we says now a little bit over 3. You could get JP Morgan, Berkshire Hathaway, Meta. You could get Netflix, Walmart, Amazon. You could get Disney, Home Depot, Google. Or you could get McDonald's, Pepsi, Salesforce, Coca-Cola, AMD, Bank of America, Johnson & Johnson, Costco, and P&G, Procter & Gamble. So, I mean, what are you taking here, Geoff?
Well, these are all public companies, and NVIDIA is in the space that everyone wants to be in. So these aren't, control prices for being able to buy all these companies. So I think it reflects the stock market valuation on them as pieces of stock and not as what someone would pay for buying the whole company. So
yeah. It's pretty fascinating though, isn't it? It's pretty crazy. I mean, it's like that. You look at the chart of NVIDIA and then you look at the chart of the S&P. I'm like, yeah, they're starting to look a lot similar. NVIDIA up, the market's up. NVIDIA gaps up, the market gaps up, and vice versa. So interesting times that we're living in, huh?
Yeah.
Does this remind you of a different era in your investing career?
Yeah. On the retail side, not on the institutional side, but on the retail side, we're in the same situation as .com. AI has gone full .com in terms of the public awareness of it, how it's talked about, all that. But we haven't seen the kinds of things in terms of IPOs and all that stuff that also was happening in the end of the 90s. It was both a retail thing and institutional thing. This time it's a retail thing.
Mm-hmm. Crazy. So I pulled this question because I just got done reading Master of the Game, how Steve Ross rode the light fantastic from Undertaker to creator of the largest media conglomerate in the world. And somebody had actually sent in an email saying that I'd love to hear what Geoff is thinking about Charter right now. He's spoken about Malone before, and he's spoken about debt on the most recent podcast. Given what the stock has done and where the valuation is, and given where the leverage is, I'd love to hear what he thinks about the stock right now. So I'm going to pull up Charter, and we can talk about that. There's a few other similar companies that we could talk about, but I thought we can just start with Charter and get your thoughts on it and go from there.
Mm-hmm. So we talked about Malone and all that, right?
Yeah.
And I guess what else have we talked about that's similar? We haven't probably talked much about cable, I would say, right?
Mm-hmm.
Let's see. Yeah. So obviously you have leverage, right? And then of course you have leverage at other levels of the Malone business. The honest answer for me is that these are businesses. I also looked at Sirius, which is another Malone one through a different thing, because there's a tracking stock, but then there's also the stock itself, and they're going to be merged at some point. And so that was also interesting just because of what was happening with the price of the stock. Just looked interesting in terms of, it looked like it was driven by non-business reasons why the stock was declining that way. So the problem is when you have a lot of leverage and you don't know if it's going to grow in the future, right? And that is the issue that I have with Charter. It's the issue I have with SiriusXM, all of those things. When it was in a phase where it grows all the time, that's different than in a phase where you think there's going to be churn and you're going to be losing customers over time. And I don't understand the business well enough. I should point out, what are we? We're in 2024. So I last had cable in 2011. Yeah, I haven't had any cable service since then. I've had internet, but I have not lived in a household with cable for a very, very long time, which can give you an inaccurate idea about things, because sometimes you're an early adopter of something, and so you have very inaccurate types of things. The first quarter the Kindle was out, and I've had it ever since. Obviously, it took a long time before other people adopted it, so you could be overly sensitive to that. But you've got fixed operating expenses and you have fixed financial leverage, so you want to be sure it's something that doesn't decline over time.
Mm-hmm, mm-hmm. So you're more so worried about the durability of the business, it sounds like?
Compared to some other things, yeah. I mean, we talk about movie theaters and things. I think this is much more exposed in some ways to dangers of that than something like movies or something like that. I don't think the durability is as high, but it laid down a lot of infrastructure, which can be used obviously for internet things over time, and that's where all the money will be in. But yes, I do think that compared to certain other things, it's not as good in terms of long-term durability. Sure. That's why I compared it to SiriusXM, where I have the same concern. Not the end of the world, but it is pretty risky when you have operating leverage and you have debt. We've talked about before, I did invest in Weight Watchers when it was a company that had debt. And so it got through that and whatever, but many years later, you had these drugs come out, right? And so that changed what it was for that company. And the cost structure and the financial leverage is still the same over time.
Mm-hmm. Mm-hmm. So I guess if you were thinking about investing in Charter, what would you be thinking? Would it be just too hard pile? Would it be you like other things more than that? But let's say your mandate was you had to have some sort of allocation to this company, right? Or maybe you ran a larger fund where...
Well, I would look at it if I had to have telecom, but I think I probably wouldn't have any telecom. Yeah. Probably would not. Yeah, have telecom. Yeah, I think that's true. I don't think that I could think of any telecom that I would have. But people invest for shorter term things, diversify more, part of a larger fund. You want to have exposure to those things. We don't own any semiconductor things and probably won't. So yeah, I would probably not for those reasons, just because it's not something that just like I said, I feel like I don't understand it that well, because obviously the customer behavior is very different from my behavior for a long period of time. And then you have to project forward what will happen in the future, based on, we could just look, you'd have to get into details with this company because it changes over time in different ways, but there's no doubt that you have a big decline in terms of revenue and any of the revenue growth rates and things at any of these companies. So, the easiest way to get out from a high fixed cost structure and high financial leverage is to have high amounts of nominal growth in terms of revenues. It's the easiest way to fix that problem and make me not worried about it. So, but I know it's a very popular industry with a lot of investors, and that it doesn't mean that it won't be a good investment. It's just probably an area that I'm disinclined to invest in.
What's going on with SIRI?
Well, just
Sirius XM.
Yeah, you could just show a chart on that. It might explain what I'm talking about, to give an idea. So there's a tracking stock, and then there's the stock itself. And I think just from a chart, well, if you go to a longer term chart, say a year or something, we might be able to see what I'm talking about. Is that a 1 year chart? Oh, there you go. So there's some behavior in the stock that seems unusual to me. Probably not a business type thing happening there. It's probably dynamics that have to do with the tracking stock and the other stock and how it's portrayed in the press and all those things. I think there's probably more people focused on the arbitrage type thing of it than are watching the business anymore, and that changes kind of how something trades. And I think it has an effect on both stocks anyway. And people assume one of them is rationally priced, but I'm not sure that that's true. I think that it's possible for them both to be irrationally priced at that point. So it's cheap, but again, one thing, I don't use radio at all and haven't forever. And I'm not in their target generational demographics, right? I think that they don't expect to really have as regular customers millennials and younger. They expect to retain people who are like Gen X and older for long periods of time. So people who were raised on terrestrial radio and prefer this product, but not people who only had streaming things that way. Have you ever had Sirius XM?
Only when it was given to me when I purchased a new car, or not new, but a car that gave me the trial. Yeah.
Yeah. So you never have your phone in there, and
Spotify. Mm-hmm.
And you use Spotify. Okay. Yeah. And you listen to podcasts, I assume, or audiobooks, not to like talk radio.
Yeah. Mm-hmm. Yeah. Never talk radio.
But you probably didn't grow up listening to talk radio.
No. Mm-mm.
By the time you were commuting or something, it probably was already something that you had phones and internet, things that people were using more commonly, instead of someone who had to be retrained from their daily practice for a very, very long time. Mm-hmm. It's attractive a lot on the numbers. I always worry about something that I feel like might not grow much at all when it has a lot to grow out of.
Is this going to be a capital allocation story? Like try to buy back or pay down a lot of that debt or buy back stock? Or I feel like I remember in 2019 and then obviously 2020 when the stock was super popular, it was, I thought a buyback story.
Yeah, if it was something like that, to be honest, I would prefer something that's extremely light on tangible assets when it does that. That's why I said things like movie theaters and stuff. If they're both facing existential sorts of risks, I don't think I'd be very excited about a railroad that I thought wasn't going to keep increasing over time in terms of that I thought it would lose volume over time or something, or a shipyard or a toll bridge or whatever. I would rather something that's very, very light on those sorts of assets and could reallocate large portions of it to something else. Now, to some extent they can, but I don't think that they will. I think that they'll buy back stock, or that they would pay you dividends, and that they would. I mean, do you remember what happened with what had become Curate, QVC? Yeah, I mean, did it keep buying back? We could look at that. What's there's a couple of share classes.
The data's not looking the
No.
best. They're here. Let's see if I can find a different one. Well, here's a stock.
Okay, but I wanted to see. So if we see the chart, even if your chart is out of date, I was curious because, I mean, your financial summary. I was just curious what they did as time went. Did they keep buying from say $14 down to $2 or something, or what did it do? So they were a heavy buyer of their own stock in like 2018, 2019, 2021, 2022. What am I seeing there exactly?
Yeah, you're seeing up until 2021, basically.
And they added debt, yeah. And then what did the stock chart look like from 2021 or so on?
Basically the peak. Yeah, it was $13, $13, and now we're at 66 cents.
Now, it's somewhat complicated, but if we go back there, did they pay dividends out? I mean, they took on debt, but I think they did distribute something.
Mm-hmm, they did. In 2020, well, not in 2021.
No, that's the big debt. That's the recap type thing in 2020,
sorry.
Though, right?
Yeah, so they paid out. They paid out $503 million in 2021.
What do I see there in 2020?
You see the same thing. So debt went
in dividends. In dividends,
1.2 billion. Yeah.
Well, that's not a normal dividend. That's some sort of huge distribution.
Yeah.
Yeah.
Mm-hmm.
Yeah. So I don't know the details there, but at a high price, still bought back some stock, distributed something, and then like the business kind of deteriorated over that period. So there is a concern about like buying back stock as you're getting worse and worse off, obviously. But if you get the cash out, that's fine.
Mm-hmm. Mm-hmm. Do you like these businesses in general, though?
No.
Or is that just a stay clear away from these? Because somebody else had sent in about a stock that honestly I haven't ever come across. I hope you both are well. I'm reaching out regarding a nano cap position Ted Weschler owns in his personal portfolio, Optical Cable Corporation. Given the size of the position relative to his net worth and his local connection to the area, it piqued my interest, and I followed the company closely since Ted filed the 13G in late 2018. I've been in contact with the managers, toured their facility, and attended the annual shareholder meeting in March of this year. Given the company's size, it's been hard to get any good insights other than what is disclosed in the filings and what I managed to discern when I visited them earlier this year. I figured it was a long shot, but if you have looked at it, it would be great to chat and or compare notes. So I figured we could look at that on here because honestly, I was not familiar with it. We've looked at a few of these companies before, like NUVR Communications, right?
Okay.
Stuff like that. But yeah, so $21 million market cap, 30 million EV. I imagine it's very illiquid, so everyone be careful with that.
Well, I mean, we could talk about NUVR is very small and illiquid, but I think that this, sells into the telecom business, the one that we're talking about here, optical cable, I would assume. Yeah. So it sells equipment to them, basically, what we're talking about, instead of operating.
Mm-hmm.
In the case of NUVR, is that what their name operates under that? This is the new Ulm.
Yeah, new Ulm.
Before, right? Do they really still call themselves NUVR, or did they change the name?
They changed their name, yeah. But the ticker's the same. This is one where the guy from, what was that fiber company?
Frontier, probably?
Frontier, yeah. He worked there, right? And then he came here and put a bunch of debt on this, and it's more of a recent thing, right?
Yeah, so with that one, I mean, I don't deny that it's cheap. Or was. The stock actually may have gone up a bit since then. But after they slashed their dividend and everything, the stock was down a lot. But the problem with that one for me, obviously, is there's this whole build-up that they're doing, and we don't know what the returns on it will be. And so we can see the chart there. You can see on the far right-hand side how far it came down. Right? It fell from over $20 or something to at least $8, and maybe it's back up a little bit, so... And that, is all because of the dividend issue, basically, that they're going all in with expansion. I don't remember if it was a total suspension, but it was effectively switching from being a dividend play to a heavy CapEx far beyond their capacity to self-finance if their plans that they actually talked about came to be way beyond any possibility of that if they really were going to do it. Yeah. So for me, when they did that, it's not that it was too expensive or something, but just looking at it, it was probably one that I'm not going to invest in at all because of that, because of that heavy push into those things. These are extremely long-lived assets, so. I mean, I don't think you get your money back out of them that quickly in terms of cash compared to other things. I know that we use EBITDA and all that, but EBITDA, a business that has no need for CapEx, it pays out as a value trap or melting ice cube or whatever you want to call it much faster than something like this. So it's not, look, all these companies are in an industry where EBITDA is not so much the thing that I want to focus on and look at, because I'm worried about the possibility of a deterioration in, like we said, durability and stuff over time, leading to the fact that you don't get good returns on the investments that you're making as you go.
So when comparing that to movie theaters, you feel like, given that movie theaters are more capital light than like a charter, you would be more interested in a situation like that?
It depends on the movie theater, but a lot of them could walk away from anything they signed 5 years. Like they might have a 5-year option or something. Some of them might have very long-term things, a variety of different things, but they could leave, and the landlord isn't going to find something better than a movie theater for them generally. So they're not committing to spending a lot of money to be there to help their customers for the long term. They want to close them down, they can close them down. They can get rid of people fairly easily. They can, it's obviously an industry that's easy to shrink if they want to do it. Some of them own it, but even when you own it, it has other uses. We're talking about something highly technological here. I don't know enough about it to know what other possible uses you have for things other than serving people with pay TV and with high-speed internet access. And if those things are really important to people, then okay. But that changes more over time than something like people sitting in a theater watching movies, it just does. And so we're talking about much more highly specialized and long-lived assets. So I don't want to just be all negative on it all the time, saying the whole industry. But if we're saying a summary of like what industries might you want to avoid when they're in decline from business history, industries with long-lived assets that are highly specialized and that they're continuing to invest in. Yeah. Whereas things that can be liquidated, whether gradually or quickly, and put into other businesses is different. I mean, we just visited something that had been put in, right, as a lease on something at a mall and everything. And you saw how easy it is, really, and they're considering, some store went out and stuff. They're considering another one where they said, okay, the movie theater is going out, so maybe replace them. There's not other uses for this stuff. This is it. Which is, I was a lot more confident in the industry if it was pay TV, where you're buying from a big supplier on one side. A big part of it is the content part of it. So you're very big and you buy from a supplier on one side of it and you're delivering the customers on the other side of it, right? And what you're really doing is reselling content. It's not about much else. And the durability of that content is something that I could understand you as effectively a middleman doing those things. As a utility delivering internet service, basically, I feel differently. I feel like it's highly technologically what will happen over time. Will people compete with you in different ways? Will people, what alternatives they could have to that? Yeah, I mean, I would be concerned, but you'd be concerned if you were looking at a trucking company versus versus barges versus railroad or whatever. If you're not, you wouldn't invest in a railroad unless you were sure that it has extremely long durability and that it's the lowest cost way of doing certain things, right? If some technology came along, self-driving trucks, let's say, and the insurance costs are much lower and the fuel is different, because they're electric or something, and then you have to look at that and say, do these railroads make sense? Right? Technological change. Technology is going to change a lot more fast in these things than basic human behavior about some stuff, you know? So yeah, there's been dramatic change in retail or something, but that's because the internet, that change, that customer behavior is probably already there. They probably would have loved the store to deliver to them in the middle of the night, free shipping and whatever. It just wasn't a possibility. But yeah, it's no, it's not an industry that I would personally be wanting to be invested in for the long term, because it's got so much susceptibility to changes that I don't understand, and it's has high operating costs and high financial leverage. So a constant churn every year of losing subscribers over time or something, you know, I would want to know that you're going to have the same or higher subscribers every year probably, and I don't believe that you can know that anymore in this industry.
Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focus Compounding Podcast. If this is the first time you're joining us, be sure to check out all of our content that we push out to the investing universe. Be sure to hit the subscribe button wherever you're listening or watching us here today. And of course, if you want to learn more about our money management services, you can reach out to me at andrew@focuscompounding.com. I want to thank everybody so much for all the support, and we will see you in the next podcast. Take care.